Well, hey there, everyone. Happy Friday, February 27th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you not from Redmond, Washington, but today from Bloomington, Indiana. I've got a daughter looking at IU, national champion IU. So I will already start off by saying I'm about done seeing the national championship gear around as a Buckeye, but honestly, no, it's pretty awesome. Great campus. We're enjoying ourselves. I'm going to leave shortly to do some dad stuff, but wanted to share some brief observations on the market environment on today's episode, and then get right into some of the thoughtful questions you guys have been sending in over the last week. Can't tell you how much I appreciate you guys asking questions. You can do so at any time using the comments section on our YouTube channel. We're traveling back to Seattle on Sunday and expecting a normal publishing schedule next week. So we should be back and better than ever for Monday's episode. But for now, let's do a quick check-in because I wasn't able to do a show yesterday because of the travel. Unfortunately, it just didn't work out schedule-wise. So just a couple charts to keep in mind here. Number one, obviously, a couple things have happened here, right, in the last 48 hours. Number one, we had NVIDIA's earnings, which on the surface were incredibly strong, right? I mean, they were solid earnings, certainly appeared as if that should be a really good sign for the markets yesterday. However, NVIDIA ended up closing down a decent amount. It did not have the upside follow through. So the reality, and I'll show the chart of NVIDIA in a minute. And actually, why don't I just go right there? Hold on. Let's start with NVIDIA. How about that? So here's our chart of NVIDIA. And what I would point out is to say, look, it really didn't follow through. And one of the things I've learned as an investor is when a company has good earnings, when it certainly looks on the surface like all the evidence is there that the stock should go higher, and then it does not go higher, that tells you that the movement in NVIDIA is less about specific stuff related to NVIDIA. It's more about a general risk appetite of investors, right? If investors are relatively risk averse, even with strong earnings, they're not going to want to take on the risk in their portfolio. And they're more concerned about the infrastructure, the AI infrastructure spend, the fact that a lot of AI companies are not necessarily generating the profits you would hope yet, right? And there's, it's sort of unclear whether all of this aggressive spending will be justified. So the concerns about that outweigh the optimism that NVIDIA's report, sort of entailed, right? So there's very little in NVIDIA's report, I would argue, to be, not pretty excited about. It's kind of more of the same. It wasn't much different than previous reports. But now we've got two straight earnings releases where NVIDIA has basically gone sideways to down afterwards. And that's with decent earnings. So I would say the sideways action in NVIDIA tells you all you need to know, at least all I need to know at this point, about the general risk appetite, particularly in the growth space. Investors are just not keen on the growth trade. They're pretty concerned about the sustainability of the trade. From a technical perspective, going into earnings, we had this potential breakout, new 3-month high for NVIDIA as it closes above 195. Here's Thursday post earnings closing just below the 50-day moving average. Now we're kind of languishing right around 180. So going into the weekend and really going into next week, this consolidation area, this area of support we've highlighted from 165 on the lower end, that's a Fibonacci level, 170 are the recent swing lows, 175 now the 200-day moving average. I would consider that sort of whole 10-point range as a general area of potential support for NVIDIA. So for now, holding, but certainly something to be concerned about, right? I mean, I think for bulls, you're really looking for NVIDIA's earnings as the reason why the market just rips from here, and we're not getting that. We're kind of limping into the weekend. The S&P, of course, made a new swing high, went back above the 50-day moving average on Wednesday. Yesterday, on Thursday, we actually traded below the 50-day, but closed slightly above it. Today, we opened lower. We are trading near the highs of the day, so we had a weaker open, and we've been progressing higher through the course of the day. We're recording this just before noon Eastern time on Friday. So we'll see what happens going into the close. We will be watching our short-term market trend model, which potentially goes back negative as of this Friday's close. Again, tactical time frame 6,800, that remains our level to watch in the short term. 6,550 still our long-term level of support. Now, with both NVIDIA and with the S&P, keep an eye on the momentum, right? Both of these have RSIs kind of just oscillating between 40 and 60. This is neutral momentum. So with the mega cap growth trade generally, certainly with the S&P, there's neutral momentum. Buyers and sellers are even, neither side really taking control. And I think that's the story more than anything else from a technical perspective. Last thing I'll leave you guys with, and then we'll just check in on the markets today here, is the breadth data, right? The breadth remains pretty good here. So here are the cumulative advanced decline lines, which all made new all-time highs as of Thursday's close. These are updated through Thursday's close. Here's the advanced decline line for the New York Stock Exchange. That's the most important one that I follow because it's a pretty broad universe. Lots of different types of companies represented, large to small, growth to value, different sectors, etc. Then we have the S&P large cap, mid cap, and small cap AD lines. They all made new all-time highs on Thursday. So while the S&P is flat, while mega cap growth names like NVIDIA and certainly like AMD and others are arguably more in a position of weakness than anything, to say nothing of charts like Meta and Microsoft and others, which have broken down before now. This strong breadth reading just tells you there are great charts out there. It's just not in tech. It's just not necessarily in growth. Although there are some random names in those sectors that look just fine, we want to be looking in other areas of the market. That's a theme we've been talking about for quite some time, and I think the consistently strong breadth kind of bears that out here. All right, let's just check in quickly on what's happening here midday on Friday. And again, I could only fit this show in kind of in the middle of the day, so apologies for that. But as of this moment, the S&P rebounding off the lows. It got down below 6840, currently trading down about 0.6%. The Dow down over 1%. Mid caps and small caps both down pretty good. The VIX is literally right at 20, although it spiked up above 21 out of the open. I mean, those are some important things to watch. We talk about key levels in the S&P. We'll see what sort of move we get in the afternoon session, but the VIX closing the week above 20, I would not generally consider a good sign. While stocks are kind of down, bonds are kind of up, and we can see the 10-year yield now moving below 4%, which is pretty meaningful. Here's the TLT just continuing that uptrend. We've been talking about the breakout in bonds. We've been talking about how bonds have been outperforming stocks in February. And it looks like that's how we're going to finish the month of February. For my Market Misbehavior Premium members, by the way, we'll have a monthly chart review for you ready on planning that on Monday or Tuesday, hoping Monday. But that's for those of you that aren't premium members, that's where we take a big step back from the market. We look at a lot of long-term trends. We apply our proprietary market trend model to a series of ETFs and asset classes. It has become a really important part of my general approach to have that monthly opportunity to review long-term trends and themes. Always a good time to join as a premium member, by the way. You can find more info at marketmisbehavior.com/premium. And do me a favor and use the code YouTube when you check out. That'll give you 30% off your first 12 months on any plan. Great opportunity. And again, if you're unsure, try a monthly membership. It's relatively low cost. We'll give you a good opportunity to understand how we approach the markets. Dollar, not much of a change. So I'm saying weaker stocks, higher bonds to start the day. Crypto commodities, that is, looking stronger today. Gold up slightly, silver up pretty good. The SLV's up over 5%. Energy doing pretty well also. Cryptocurrencies kind of doing the weaker risk asset thing. Bitcoin currently down 2.5%, just below 66K. Ether now back below 2,000. All of the top 10 coins here in the red. Midday here, it's definitely defense over offense. You can see consumer staples, utilities, healthcare, real estate. Those are our four defensive sectors there at the top of the list. Financials continuing to get absolutely clobbered. Here's the heat map. And we look at the heat map today. It's a lot of red in financials, a lot of red in technology. Elsewhere, not a bad day, right? I mean, and that's why the breadth conditions are still pretty good. A lot of things outside of those sectors are actually quite strong, but financials, the worst. Technology, second from the bottom. Here's consumer discretionary, third from the bottom as well. So defense over offense, value over growth. That's the general way I would describe conditions here today. And again, this is midday on Friday, so we'll see what happens going into the close. But we will be watching our market trend model, see if that short term flips back to the negative side, which is a very real possibility. And for my premium members, I'll have a lot more to say along those lines in our weekly flight plan, which should come your way this weekend. All right, if we could Shall we get to some of your fantastic questions? As a reminder, these are questions that viewers like you have sent in over the last week. You can get your questions to us on our YouTube channel. Just drop a comment below any of the videos on that channel. I read every comment that comes in, and I appreciate your feedback as always, and very much appreciate your questions. These are questions, again, that I pulled just from our YouTube comments in the last week or so. Question number one, what is your opinion on JEPI and JEPQ or similar strategies? Yeah, thanks for asking about these. These are a series of income ETFs, and you're asking about the JP Morgan ones. But now I think, pretty much I feel like most big firms have generated some ETFs like this, those that are in the ETF game. So what are these basically doing? So these are essentially an index ETF with a covered call wrapped into it. What does that mean, right? So you're owning an index ETF. So basically you're owning the S&P, and the other one you asked about was JEPQ, which instead of the S&P is like basically a NASDAQ version of the same ETF. So this is JEPI that we're looking at. And so essentially by owning this ETF, you are owning the index or an index fund, but then it includes a covered call wrapper, right? It includes a covered call structure in there. Now, what you have to remember is with ETFs like this, they're usually using some sort of interest rate derivatives to replicate a covered call strategy. They're not necessarily owning options as part of the ETF. Most ETFs and exchange traded products use the interest rate derivatives market, interest rate swaps of some sort to sort of artificially create it. So the risk involved with these ETFs, there are a number of risks, and you should always do your due diligence. But one of them is you're using derivatives. And while it generally will give you a certain exposure during periods of heavy market dislocation, like flash crash kind of moves, it can be a little bit unpredictable. So generally speaking, they're going to do what is expected, but there can be times when, because of the nature of the market, there's counterparty risk because they're creating swaps with other banks. And so there's liquidity risk and all those sorts of things. So just please do due diligence if you are considering any of these ETFs, which I think, to be honest, should be part of your process. If you ever buy any exchange traded product, do your due diligence, understand who's running it, what bets they're actually making, what securities they actually hold, how much are they using the underlying securities versus using derivatives to replicate some sort of return profile, what are the expenses, what are the management fees, what are the bid-ask spreads. These are all things I would want to understand before I would even consider taking a shot at any exchange traded product. So what does this do, right? So covered call strategy, right, is where you're basically selling call options on a position that you own, right? So selling call, writing a call option, it's called a covered call because you own the underlying security. So you own something, you're selling call options on that same thing. So what that means is you're gaining some premium by the people that want to buy that call option, right? They're paying you for that right. So what does that actually mean in terms of your return? So what that should do is basically your upside should be a little bit less. So if the S&P 500 goes up 20%, something like JEPI will still go up, but would almost certainly go up less because you are, you're gaining some premium, but you're giving up some of the upside because you're selling options to someone else who can benefit more from the upside in the S&P. But the real benefit, which is why it's more of a defensive play, is you're cushioning yourself from the downside. So if the S&P is flat, JEPI should be gaining value because you're basically flat in the index, but you're gaining premium on the options. And if the market is down, you might be slightly higher, most likely would be down less, right? So if the S&P is down 20%, you should be down less, again, because you're gaining that premium. So you're limiting your upside a little bit, but the other part of that is you're also limiting your downside. You're going to outperform if the S&P is flat or down. You're probably going to underperform if the S&P is up. So this is instead of selling your position in stocks, you add a covered call. So this basically combines all of that into a wrapper. Let's look at what's actually happened in 2025 to 2026. And you can see it's worked out, pretty well, right? In a downtrend, right? February, March, April of 2025. Look at the bottom series. This is JEPI versus the S&P 500. So using that covered call, related ETF, you're outperforming the S&P while the S&P is going down. The problem is from April through end of October, you're underperforming because the S&P is going higher. So you're losing versus the S&P, or underperforming the S&P because of that covered call part of it. But then here, the S&P has been flat in December, January, February, and look at JEPI has been trending higher. So you've been outperforming, during a period where the S&P is flat. So what it is intended to do over the last 18 months looks like it's done pretty well. When the S&P is flat, you're probably outperforming. When the S&P is down, you're probably outperforming. When the S&P is in a big long-term uptrend, you're probably underperforming. So, what do I think of these? It's an interesting. I mean, it's basically a way to replicate a covered call strategy without you having to open an options account or a margin account, actually doing all the work. They kind of wrap it in there. You can see the dividend yield is very high, and that's because it has that covered call component. So if you're concerned about market downside, this is definitely one of the levers you can pull, and I would say they're generally pretty decent. Keep an eye though; there are a lot of these out there, and I would, again, the due diligence that I mentioned, more liquid ones with more assets under management, those tend to be the ones that I would probably be considering more than others. Hope that helps. Next question. How should an investor manage the psychological challenge of deciding when to sell, especially when there's a fear that selling too early could mean missing further upside? I love your questions so deeply, and I appreciate it. I mean, I called my channel Market Misbehavior, mainly because I have found for most investors, this is what you don't want to deal with, which is the psychological challenges, the mindset, the challenges of just trying to do this. But I would argue that's the game, right? If we can deal with what's happening between our ears, we are at a much greater advantage than other investors. So how should we be managing the psychological challenge of deciding when to sell? So number one, I would say, remember, fear of selling too early. That's what we want to get away from. We want to get away from the anxiety related to stocks. Don't think of this as an emotional decision. Thinking of it as an evidence-based decision. That's what I do with my premium members. I try to encourage them to rotate from an emotion-based investment process to an evidence-based emotion process. So your question is like how do you deal with the psychological challenges, right? So selling too early, it doesn't feel great. And that's when you sell when something's up a little bit, and then you sit there on the sidelines as it gains a ton more. That's tough. Selling too late hurts too, right? When you have all these great gains on paper and then you give a bunch of them back. And I'm looking at Palantir as an example of something that's topped out here recently. Selling too late doesn't feel good either. So ideally we want to sell, we want to better time our selling decision. So if your challenge is you tend to sell too early, we want to upgrade the trend following part of our technical toolkit. I would encourage you to be using moving averages more. There's an indicator called the chandelier exit system, which is a really interesting way of, sort of locking in gains, sort of a trend following, kind of a trailing stop type of indicator. If you go to the Stock Charts Chart School on their website, it's a free resource. They've got some great articles on the chandelier exit system, which is pretty good. It's based on average true range. Moving averages are a great way. So I use the 21-day EMA as an initial stop when a lot of times when I have a long position. The 50-day moving average I tend to watch as well. And keeping an eye on those moving averages can be quite helpful because it allows you to get out before things get really bad, right? I was taught all large losses begin as small losses. So if your problem is you tend to sell too early and then you miss all these great gains, we just want to do a better job of following trends. You're getting shaken out by short-term pullbacks. So we want to look at longer-term charts and focus on longer-term trends. If your problem is selling too late, then what we want to do is, do a better job of using stops, right? Looking at support levels, looking at moving averages, looking at momentum, watching for the RSI to break below 40. Those are some of the things that I would focus in on. So I would say, think of it in two different ways, right? Either one of your main issue is probably you're selling too early and leaving gains on the table, or you're selling too late and you're giving up some of your previous gains. And given which one of those it is, that's where I would focus my attention. Last comment I would make, and this is a subject of a whole other webcast I'm feeling like I maybe want to do here very soon, and I'll let you know when that's going to happen. Think about moving in stages, right? I think individual investors think too often like I'm all in or I'm all out. I own 100% of a position or 0%. Professional money managers will incrementally add to positions and incrementally remove positions. So if we break an initial support, take a third of the position off. Leave the other 2/3 there. Take a third off. And then if it breaks down further, you take another third off. And then when it hits your final level of support, you take the last third off. Then if it's just a quick whipsaw, you take a third of it off. If we recover, you can always put it back on. So think in stages. Don't think all or nothing. That's all I can give in one mailbag episode, but great question. All right, next question. Market has been caught in a consolidation. However, the volume has not declined. How fast do you think it may break out of this consolidation phase? So great question. I will tell you this. I don't tend to think in terms of the timing. For me, this is not all right, the S&P is sideways, which means we've got another couple weeks and then it's going to break out. A lot of technical analysts do that sort of forward-looking timing based on cycles, based on turning points. Larry Williams always puts out great content thinking about forward-looking cycles. That is not my game. I'm not the crystal ball type of analyst where I'm sort of saying, all right, the S&P is going to do this and then this and then this, and here's why. For me, it's more about trend following. It's more about keeping your eyes and your ears open and recognizing the changes. So for me, it's not about a stopwatch and then when the alarm goes off, then it's time to break out. This could go sideways another couple days. It could go sideways another couple weeks. It could go sideways another month or two. All of those are possibilities. So for me, I just think of this as a sideways chart, which means I'm going to be patient and I'm going to wait for the break. And that's why I often highlight these are the levels I'm watching, because it's less about timing at a particular moment where something's going to happen. It's more about just keeping my eyes and ears open and not missing the break, right? And that's where I think honestly, traders and investors spend too much time trying to predict the future and think about what's definitely going to happen and then build a thesis around that. For me, it's about just being aware, having good market awareness of what actually is happening, having a consistent process of reviewing changes, reviewing shifts, reviewing breakouts and breakdowns. That's where I think we want to focus our attention. All right, we're going to continue on with the show here in a moment. Just want to take a moment to say thanks, as always, to one of our partners, Koyfin. You can find more information about their platform at marketmisbehavior.com/Koyfin, Koyfin. I use that platform all the time for ETF holdings, for analysis of non-US markets, for deeper fundamental data. Anytime I want to look at earnings trends and estimates, that's my go-to platform. If you're an advisor, they have some really good tools to help you have a really rich and meaningful discussion using market data with your clients. So check it out at marketmisbehavior.com/Koyfin. They're offering 20% off their platform right now. So check it out. You use my link. It gives you a little better deal than it would normally and helps me to make market misbehavior awesome. So I appreciate you checking them out. Next question. What will the chart of Netflix show before you will consider the trend reversal? I use the RSI over 40, 10-day moving average crossing over the 50-day moving average, and heavy volume as the indicators. Really interesting take. Let's look at the chart of Netflix. And I don't disagree with some of the things you said. It seems like a pretty decent way of evaluating it. What would I look like? So interesting that you asked that question before this whole move, and they gapped higher because of the M&A announcement. Basically, it's the whole Netflix, Warner Brothers, Paramount sort of debacle, and Netflix opting out. Stock is bouncing higher, 10+% on the news. So you asked this question actually back here, and we highlighted this, I think, on the show, maybe on Wednesday, I want to say, I forget. But, for me, I think of, in a downtrend, we're making lower lows and lower highs. We're below downward sloping moving averages, RSI below 50 and mostly below 60, but usually below 40, usually below 50. And then the relative strength going down. All those things have now shifted. Netflix is now bouncing above its 50-day moving average. RSI finally pushing above 60 for the first time since last summer. Relative strength starting to turn higher. Now, this started to spike earlier this week as rumblings were beginning about potential announcements with this deal, and obviously it's gapped up pretty good. Post gap, right, if you've been ignoring this, I would say at this point, from a technical perspective, it's in a much better position in that it's now pushed higher. All the momentum is improving. The question is going to be what happens next. After this gap higher, do we see additional buyers? And at the moment we move another tick higher, I think that's a pretty bullish chart. So I think early next week could confirm that the 200-day moving average is looming large above current levels. That's almost 20 points away. So I'd say at this point, at least it's a neutral chart. It's not a really bullish chart structurally, I would say, until we can get above the 200-day moving average. But is it is it a bearish chart anymore? No, I would say no. And I think that started to shift on Wednesday and Thursday. Friday's gap higher kind of completed the move. The question now is, do we hold the 50-day if we get in any sort of a pullback here? Also watching the momentum, making sure that it shifted higher. So for me, getting back above moving averages, RSI back in the bullish range, those are things I would be looking at. It's a gappy chart because this is an M&A chart, and that's one of the realities of investing in stocks, particularly ones invested in some sort of merger or something, is there can be big gaps higher or lower as things are announced, as things change, as deals are come into fruition or out of fruition. That's my take on Netflix at this particular moment. Next question. You've shared a chart before, number 405, the MOVE versus the VIX, but you haven't mentioned it in a while. Can you explain what is the MOVE index for? Yeah, real quick. The MOVE index is kind of like the VIX for the bond markets. So I have this chart, which you asked about, which has the MOVE in the top half and the VIX in the bottom half. The VIX we're probably familiar with, right? It looks at the equity options market or the index options markets. These are looking at S&P 500 index options. It looks at the volatility of those options to imply a volatility for the S&P. So it's basically, what is the options market pricing in terms of expected movements, day-to-day movements in the underlying index, in this case, the S&P 500. Well, there are options traded on bonds, and there are underlying securities that track bond prices. So the MOVE index comes from ICE, the Intercontinental Exchange, and basically tracks volatility in the options market for bonds. And so similar idea to the VIX, the MOVE index getting lower means the market pricing in less day-to-day movements in bond prices. If the MOVE index starts to trend higher, it's pricing in our heavier swings. That's been one of the biggest changes I think that we've observed now in 2026, 2 months in, is an increase in bond volatility and increase in equity volatility, as referenced or as implied by those options markets. And sorry, I had the VIX covered up that whole time, but hopefully you got the point. Great question, by the way. All right. 2 more questions here, and then we'll call it a day. When watching financial television, CNBC, Bloomberg, etc., how can we evaluate the quality of a stock analyst's insights? What are some indicators of genuine expertise or lack thereof? That's a loaded question because I've done a lot of financial media. I used to work for Bloomberg, so I've got a lot of connections in the media space. And most of the people that are guests, I mean, a lot of them are, especially in the technical community. I'm sure I know them and have worked with them probably at some point. So that's a tough question. What to say? So here's what I would tell you. One of the main reasons why, and I'll just give you a general thought, and then I'll give you some specifics. So as a general thought, I would say, I started the Market Misbehavior podcast, which you can find on my YouTube channel, and I know other people have started financial podcasts as well, basically because we're frustrated by how traditional financial media and financial media treats guest interviews. And I've gone on a lot of TV spots. Yeah, 3 minutes usually. 5 minutes is super generous. You usually share a bunch of talking points. You may or may not get asked about specifics, but you're basically there to share a couple quick sound bites. But you never really ever can get into anything truly meaningful, right? You're there to share a couple things, share a couple charts, share a couple, and then they're gone. They're already talking to someone else. So as a guest, it's horrifically frustrating because you never really get a chance to get into anything. The host doesn't really have a chance to ask any unscripted question like, hold on, you said this. What does that actually mean? Which is why a podcast is so much fun, because when someone shares something, I'm like, hold on a second, how does that relate to this other thing that this other guest said? And it's a meaningful conversation. So I'm enjoying doing a podcast because I get to do the interviews that I wish CNBC and Bloomberg would feature, because they're just not long enough. And they're just not unscripted enough. They're heavily scripted, and people going on TV kind of have a pitch that they're making. That gets to my second point. I would say the challenge with financial media, and I know when I'm going on there, I already have my talking points ready to go. I'm not kind of winging it. I kind of know what I want to talk about, and I know, and even if someone asks something, I kind of have a scripted answer I'm probably ready to give. People that go on media a lot, that's just what you're trained to do, because you don't have a lot of time. You don't have a lot of time to think of an answer or ruminate on what might make sense. You just have to answer the question and move on. So I would say just keep in mind that people are going in there talking their book, they're talking their perspective, they're talking up their product. Anyone who's going on TV has something they're trying to sell, and they're doing it to try to get exposure for that. That's the reality. And I don't think that means all of what they're saying is bad. I think a lot of what they're saying is actually really good. And people that say interesting things that make you think, I think you should check them out further because they might help you down the road. What are some indicators of genuine expertise? So the reality is, especially on large networks, there's a lot of vetting that happens. People don't just accidentally end up on TV, and if they're not good guests, you won't see them again. And I've seen that happen where someone has a bad interview and then they just never get an invite. You get invited on there because they've done their due diligence. They think you're credible. They like what you have to say, and they think they want to get your message in front of a larger viewership. And so I think the fact that they're on there says something about them or their firm that is pretty good. For me, I would just say never. It's listening to someone on financial media is not just about hearing what they have to say and then just trusting them completely or just doing it. If they say this is bullshit, believe that that's true. For me, I always treat financial media as a reason to dig in deeper myself. That should give you the things to put on your watch list. And that watch list are things that you're ready to dig into deeper. Don't just take something on the surface and assume that it's a great idea just because you heard it on TV. Final question, really more of a comment. So if the S&P 500 falls below the 200-day moving average, you could play taps. Thank you for a fantastic market recap. Thank you so much for watching, and thank all of you. Definitely has crossed my mind. I've talked about the S&P over 7,000. I will play something more positive and uplifting. I don't know about taps, maybe blues. I've got some bluesy, more, that sort of vibe that I can work up if we break below the 200-day moving average. Challenge accepted. That's the other side. We break below the 200-day. I'll play some blues on the air. That'll do it for now. I have to get to being dad for a little bit, but thanks, listen, so much for watching my show. Thanks so much for those thoughtful questions. Those all came from people like you in the last week. Please keep them coming. Have a wonderful, joyful, restful weekend. We'll be back with you on Monday. In the meantime, remember, it's always a good time to own good charts. Take care, folks.